Hello, Kurt Jackson here with this week's installment of Your Money Matters. We're continuing our long-term theme on Confessions of a Traditional Financial Planner, and we've last week we started kind of a little sub-series on alternative retirement strategies, and we're going to continue that today. We're going to talk about ways to invest for income, because isn't that really what we're looking for when we are putting money away for retirement? I mean, it's not that we're trying to build this big pile of money, right? We want to be able to create a cash flow that we can live on for the rest of our lives, no matter how long that is. And isn't that ultimately what we're looking for out of that money? And I know that's kind of simplistic. There might be some other things, but that's really the core of it for most all of us. So typical financial advice follows that accumulate now, save now, get that big pile of money, withdraw later plan. And the problem with this, as we've talked about earlier, is that people live on cash flow and not on net worth. Okay, net worth might be important, but you don't live on net worth. And typical financial strategies for income, they may not even keep up with inflation. See, typical financial advice says to accumulate as much money now as you can in a 401k or other investment accounts and until retirement, and or whatever time you decide to start taking your distributions. And at this point, we transition all, or at least most, maybe all of our money, possibly after paying the tax man, and then we move those into income investments. Things like dividend stocks, maybe higher yield bonds, and to a lesser extent, in typical financial planning, is annuities. The people they badmouth annuities quite a bit in typical, but they will use those probably in the most inefficient way possible is with annuities. While these big investments are generally thought of as secure, dividend stocks took a big dive in the Great Recession. And the bonds that pay more aggressively are often not quality investments. And see, typically you're advised to keep a portion of your assets in cash or cash equivalents, such as CDs, certificates of deposit at the bank. Although rock bottom rates that we've been in for a long period of time are encouraging seniors to take more risk. Then we're taught to draw down our assets at a 3 to 4% of principal, right? Yeah, and I know that former 4% rule is downsizing due to low interest rates. Withdraw faster and you can run out of income in retirement. Funds in those taxable retirement accounts remain subject to future taxes at an unknown rate, as well as various qualified plan rules. Okay, the funds outside of qualified plans are often taxed as capital gains, and those rates have started to go up. They went up last year. The problems with typical income strategies are multiple. Income may negatively affect Social Security income. Your assets may not hold value. Earnings can be low. Oftentimes, continued taxation and high fees continue to not only chip away, but really just hammer away at your investments and your cash flow. But probably the biggest problem, the most important problem that typical financial strategies is that there's no fallback plan if rates go down or inflation rises or major emergencies arise that might consume significant assets. They don't have that bailout plan. So it's no wonder that seniors now say their greatest fear is running out of money. It's not dying too soon anymore. It's running out of money. And that's because that accumulate now, to build that big pile of money, draw down later, take income. It's a poor plan that has no emergency exits. See, when clients come to us with typical investments and taxable retirement accounts in their portfolios, we work with them to strategize on how to sequence the consumption of their assets, meaning how to take out that income, to minimize their taxes and put more money in their pockets. Because I think, isn't that what we really want? So people tend to withdraw a little at a time from all available assets, and that's rarely an efficient way of doing it. By consuming the taxable accounts first, which goes totally against traditional financial planning, and or moving funds out of taxable accounts into tax-advantaged accounts, investors can keep more of their money over certain timelines, and not every. It's kind of just some general things that we look at doing to see if they make sense for someone. They don't make sense for everyone. However, we don't suggest using typical investments when your goal is sustainable income. Instead, we recommend investments in savings vehicles that offer, a security of principal, healthy returns, and flexibility. One of the things we talk about, which traditional financial planning, and you never hear anything good about, but that's through our research, that's largely because they're not using accurate facts against these are, but it's a properly structured permanent life insurance policy. See, when we fund a permanent life insurance policy properly, it's not only a great way to save long term, but it's a product and a strategy that's inside of this vehicle that can offer additional benefits to those that are desiring future income and additional assurance. Cash value of these permanent policies, they've historically produced healthy and reliable income in retirement. And this strategy can provide you with greater safety, more stability, tax savings, and flexibility, a lot more flexibility compared with traditional income strategies that would include annuities. And when I say that, it's including the traditional use of annuities. The non-traditional, the alternative use of annuities, you find a lot more flexibility. With proper riders, permanent life insurance can also provide kind of a form of disability income. We can even accelerate the death benefit in case of a terminal illness or a critical illness. The other thing that we talk about is something, if you'll notice a theme, it's things that traditional financial planning really kind of blackballs. And in my opinion, through all my research and my experience, the reason they're blackballing them is because they don't want you to know about them, because if you knew about these strategies, you would use the traditional ones less, and then you wouldn't do business with those traditional advisors. But the other one is a reverse mortgage. Now, I know we hear terrible things about them, and you're right, when they are not used properly, they can be very, financially treacherous, but when used properly, okay, they can be phenomenal tools. And it's a product that can also provide some additional tax-free income, some additional security, some, help you keep that peace of mind. And it's really good to use to address what-if situations when you need more money than you anticipated you were going to need. Reverse mortgages can allow seniors to spend their home equity while remaining in their homes with no mortgage payment. But keep in mind that you still got to maintain the house, you got to pay your property taxes, and you got to pay your insurance. So it's not like all your housing costs go away. It's no different than if you had a house free and clear with no mortgage payment, but you still have property taxes and insurance, and you still need to maintain the property, right? So it's the same type of requirement there. Reverse mortgage income does not negatively affect Social Security income because it's home equity. It's not income. It's you're taking a loan out on something. And if you combine that with permanent life insurance, a reverse mortgage can provide income while keeping a cash inheritance in place if that's important to you. And in some situations, heirs may actually choose to pay off the reverse mortgage with those life insurance proceeds and keep the home, or receive the remaining home equity after sold it. And face it, for most of us, the kids don't want the house; they want the money. There's those rare occasions where the kids are going to want the house, but if you're in a situation where the kids don't want the house, a reverse mortgage is something that you should utilize. Okay, put into place early in retirement, really at 62 to get the max out of it, and have it there for you. Okay, I know there's some costs involved, but the benefits and the rewards, when you sit down and really evaluate it, will way outweigh any of the minimal costs to get that started. So with typical strategies, people should really be afraid of running out of money. But with alternative retirement strategies, you'll have greater flexibility, more control, more choice. It's doing more of the things that you want your money in retirement to do. It's one of the most interesting things. I did mortgages for almost 20 years. So I started, when my clients kept losing money, I started doing more and more research on trying to find some alternative strategies. And I found these alternative strategies. And it shocked me that the financial community, the traditional financial community, was not utilizing these. But as I continue to research more and more, there's not that there's no money to be made in these, but there's less money to be made in these different alternative strategies. Because think about it, if I'm providing those to you, or the companies that are providing those to you, are, you know, if we're making less money, there's less cost, then doesn't that typically mean that you're making more, that you're doing better? So if I'm looking for things that are going to help my clients more, right, then I just have to have enough clients that, you know, what is the old Zig Ziglar? If I can help enough people get what they want, I'll get what I want. What I realized was, if I went the traditional route, for one, folks, I wouldn't be able to sleep at night, because I'd be constantly worried about my clients losing their money and not being able to retire like they want, or being worried about living their entire retirement, worried about running out of money. So when I decided to move out of the mortgage industry and into the financial planning, it's retirement income industry is what I like to call it, because that's our ultimate goal. I went with these safe strategies. It makes me less money. That's fine. I'm happy with it. I can sleep at night. If the market crashes and I see you walking down the street and you're a client, I don't have to duck down the alley because I'm afraid to have that conversation with you. And so as I researched these, I kept finding more and more reasons why you would want to have more control, more choice, using the safer routes, pay less in taxes, get more income out of less money because you're not having those losses, because the fees aren't as high. You know, we're not taking, the companies that I work with and myself aren't taking a bigger cut as they do in traditional financial planning. So all of you sitting there with those traditional financial plans, 401ks, 403bs, IRAs, with money in the market, folks, I'm telling you, if you sat down and really analyzed it, you would find out that you are getting robbed blindly. Okay, their total goal is to pull as much money out of your pocket and put it into theirs as possible. And they're in cahoots with the government, because the government's doing, you know, if I'm trying to take a little bit of money and save a little bit of taxes to build this big pile of money where you're going to pay taxes on all of the money coming out of that for the rest of your life, doesn't that sound like a plan that's going to benefit the government with tax revenue also? So we try to take a look at it. And look, I'm not sitting here trying to tell you that all that we do is perfect. But I can tell you this, all that we do is designed to give you the most for the least amount. Okay? The most efficient way, and we've got guarantees. We've got all kinds of different ways of making sure that that's going to happen for you. So I encourage you to look into alternative retirement strategies. Check out my website. It's there. It'll be up on the screen. It's www.maxmyretirementincome.com. We got a wealth of information. If you're that kind that wants to go figure that stuff out on your own, great. If not, if you want to sit down and talk about these things and find out why, I've got, you know, a whole litany of arguments against why you would want to do traditional versus what we do with our alternative retirement strategies. And if it's funny, people say when they sit down and hear all the different things we talk about alternative retirement income strategies, they say, why aren't more people doing this? All I can say is my experience says that everybody that understands it is using these alternative retirement strategies. Okay, so that should tell you something. All you really need to do is figure out how these things work, get comfortable with them, and then implement them. And we're here to help you with that. So thanks for tuning in. If you find value in these, please share the link with your friends, family, coworkers, anybody that you care about, and encourage them to watch them. I know they run a little long, but we're really trying to find ways to help you benefit, which I think is what we all want. We're all selfish in our own mind, in our own right, and we should be. So, and go back and watch previous ones if you haven't. Kind of catch up on we're doing a pretty long-running weekly deal on the confessions from a traditional financial advisor, and I find it very interesting because it goes right along the lines, almost all along the lines of what I've found through all my research. So, thanks for tuning in, and you all have a great week, and we'll talk to you next Wednesday.